Hey, what's going on, everyone? Welcome back to another brand new video, and today I'm going to be discussing my trades on gold on March 13th, where I was able to achieve trading this strategy, essentially my main strategy, achieve a 85% win rate, averaging about a 4 risk reward across this day. And this was about, let's see, across about 10 hours of trading price action. I was able to make a lot of returns. This was, I believe, over 20 risk to reward. We'll count it towards the end of the video, but nonetheless, an 85% win rate, one of my best win rate days in terms of just the statistics with the 4R average. And I'll be diving literally into how I'm able to anticipate and also react off price, and how to basically read pure price action to catch trades like these, so you guys can also catch them with me and make money every single day. So without further ado, let's get straight into it. Today I'm mainly just gonna ignore the right side of the chart. We're mainly just gonna focus on the 1 minute and 5 minute, because I want to go over something very important also in today's video that I haven't gone over, I believe, in other videos in depth. So yeah, ignore the 15 minute. If you guys think my chart's messy to follow with this split screen of 3 different screens, let me know. But typically this is how I trade now, right? With 3 different time frames of the same asset at the same time. So anyway, yeah, let's just get into the trades, right? So first off, we'll look at the 1 minute. So we'll move all this to the side and we'll focus purely on the 1 minute. So you guys know the 1 minute is the most important time frame for me because it provides us the most amount of information. And basically what happened was, this was 12:53, so this is already outside of kill zone session. I did not take any trades, I believe, before or during the kill zone, which unfortunately there's so many good setups, right? We had an internal sweep there, stop hunter straight into a TP. So many trades we could have took advantage of, but I just was not there at the charts at the time. So later on in the session outside of the kill zone, which, like I mentioned, it's fine to take trades outside of kill zones as long as you're able to understand price action and collect data, knowing that your win rate and risk reward is roughly similar. It should be roughly similar outside of kill zone as well. And mainly just like understanding market conditions and reading for yourself to see if the conditions are good. If the conditions are good, for sure trade outside of kill zone sessions. But if you're over trading, that's another problem, right? So definitely keep stuff like that in mind. But you guys can see here, what I was anticipating here was actually running this as inducement. This is clearly a small pullback that never mitigated anything prior. And I just left a small pullback to continue higher, creating this internal break structure to the upside. We're fundamentally bullish, remember, and technically. And so I was marking this ahead of time as my inducement. So if we go here and play price, that was my inducement that I marked right there. And essentially what I was waiting for was price to come back down. I don't think they can just draw right now. Come back down, take out that inducement, and then push up. Right? Or not push up, sorry. Here, I was actually anticipating for price to go down here, to take out this inducement here, for this 5 minute POI here to go higher. That was my original thesis, and you will see later I changed my mind on my thesis based on how price was respecting this POI right below this inducement, right? So right here, this creates inducement for this POI, but this pullback right here creates inducement for this POI. And you're not always guaranteed for the best price, right? You're not always guaranteed for price to come all the way down truly to the origin, right? Sometimes price would go to the flip. In this case, I was wrong about this. This was actually the flip, not inducement here. And this is, again, based on probabilities of price, right? Price ultimately just held inducement here instead of taking it out like it usually does. And you can see I draw it here also. If you guys are ever stuck on premium discount, or which POIs you want to pick, always use the premium discount tool, use the Fibonacci tool to be able to essentially filter out good and bad POIs. This is a very easy way to filter them out, so you know which ones to use, right? Anything above 50% you want to be selling, anything below 50% of the range you want to be buying. So anyway, I'll remove this. As you can see, we basically tapped right below 50%, which is not ideal, right? I prefer something for a deeper retracement to like the 0.618, which is the golden pocket or golden ratio of the Fibonacci sequence, but we never got it, and that's fine. As long as price is giving us the reaction we want, we can take a long. Point is, here I was trying to essentially anticipate price to run that inducement, so I was targeting this POI right below with the stop hunter system that I teach you guys in the course, so you guys should know that. We made a lower high, lower low, and we took out that lower high, I'm expecting this to be a fake internal change of character to go lower like this. However, as you can see, when I entered, we got in some profit, but it doesn't really count. It's not much profit, and got stopped out very quickly. So after I got stopped out, I realized, okay, if we really wanted to go lower, we should have respected this internal liquidity sweep and gone lower. But no, instead of respecting it and going lower, we mitigated this OB here after sweeping this previous liquidity and gone even higher. So this is when I just switched my bias here. I realized we were actually going higher, and guess what happened here? I could have honestly took an entry here off this, but this is more of a lower probability like internal liquidity sweep because we never made a high here, right? If we did something like this and did this, I would have taken this as a stop hunter strategy setup to go reach into this OB or this PY origin, but we did not do that. Instead, we failed to take out this high, and we made an internal liquidity sweep, and this is not as high probability, so I did not take this. But a way for you guys to enter this, if you wanted to, was you could have entered on this OB here, right? This OB entry here. And stop loss would have been difficult here, honestly. It's just too big of a stop loss for me personally. Let you guys know, I like to take trades that are at least 3 risk reward. There are a few times where I'll take 2 risk reward, and those are very small scalps. But majority of times, I prefer 3 or higher, right? Preferably 4. So stop loss, you likely would have had to put it below the OB here personally. And don't forget, you're in the middle of the range trading here. This is not the extreme low, so you got to be careful here if you were to take this. But this would have been 3R if you decide to re-enter, change your bias to go long. But ultimately, we reached into this PY here. And what happened is in this PY, we actually got confirmation here with an OB entry model, and I entered. Now, people ask me, why did I enter this knowing that this is a weak high above? Well, I was anticipating here that we would still continue lower, right? I was thinking, oh, okay, this is actually, the inducement still here, right? So I was thinking we would go back up, mitigate what we left behind, and then continue lower and then continue higher. But again, here's when I failed to switch my bias. I kept trying to go against what price was telling me, right? This is a great lesson for you guys to learn. Remember, no matter what level you're at in trading, there's always something new or more to learn, regardless of where you are, right? Every single day is a way to potentially learn from the markets. Yes, there's probabilities, but there's also ways to learn. So you guys know, took an OB entry model here. You should be able to see this without me drawing it right there. If you were waiting for the extreme OB, you never would have got tapped. I typically tell you guys I take the second one if there's multiple OBs. And we eventually, what happened was we mitigated the origin here, and we actually respected it here, and we continue higher. So what happened here was I essentially trailed my stop loss here. I wouldn't even trail. I usually don't trail my stop loss here. So instead of trailing, I actually basically just manually exited from what I remembered, right? Where was I? I mainly exited when I saw us create this new OB, right? We created an OB confirmation entry model to go higher. So I basically exited there around 1 risk reward, okay? So basically after this trade and this trade, I was break even on the day. And then let's go into the next trade. So what happened here was I see we have another OB here right below this internal liquidity right here. This internal liquidity here, I was counting as an internal change of character, or a fake internal change of character to be specific, an internal liquidity sweep. Why? Because I knew this high is still weak up here. Just because we held price here for a moment does not mean this high is a failed break of structure. Remember, a failed break of structure is not the first initial fail. Typically, it's the second initial fail. So this is not a failed break of structure. Why? Because this here can easily just be a mitigation cycle. So remember, guys, teach you guys mitigation and expansion. Pullbacks are mitigation phases. Expansion are continuations. So this is just a mitigation phase to come back here to mitigate more orders, to get more fuel and liquidity to go higher. That's all it is. So we just did a mitigation phase. I understood that, and that's why I was able on this next trade to get a 4 risk reward, getting a great trade here with a good stop loss. Now for here, I basically put my stop loss below this OB right here. You could have for sure covered this low. This would have been the most conservative stop loss to place. Where I put my stop loss is considered a bit more risky of a trade. So you guys always have to know what your risks are in trading. For me personally, just seeing this setup, knowing that we actually took out enough liquidity internally here, I thought this was good enough for me to see price get this fuel, right? Because price will not always go back to the extreme OB, and you guys know that. So I took basically a trade off here off a stop hunter system, essentially after we mitigated this PY. I was expecting this PY to fail as part of the stop hunter system, right? Remember when you're trading a stop hunter strategy, you're anticipating certain PYs to fail. So that's what you're doing. So you would have either targeted that weak high, this high, or you could have targeted this intermediate high right here for 1.8, whatever you want. But me personally, I'm trying to catch most of the move myself to optimize my risk reward, and that's what I've been tracking. So entered with a market order as soon as we swept this low right here with my stop loss below that PY or OB, just in case price wants to go a little bit lower to mitigate this, which is completely fine, right? So later you can see we bounced a little bit, we got very close to where a lot of people would go break even. But we never did, and we eventually did a fake move, right? I made another course video you guys should have watched by now, since this is the recap section, but this is a fake move in the market. Fake moves and fake reactions, you guys need to understand these happen just to fake traders out to short this OB entry model. And these fake moves majority of times do not get me. And the reason why is because I have enough confidence from backtesting experience, seeing these trades play out, see my draw liquidity play out, and knowing that this is probabilities, right? That the probability of this holding is very, very unlikely when we have a weak high target right above, and we already did the mitigation phase here. If we did not do this here, this is very possible to be the mitigation phase, come down and go higher. But no, we already did the mitigation phase, so I believe we have enough liquidity to go higher. So what happened here? We had, I drew out this low while I was trading, right? So what I would suggest to you guys, if you're trading live or backtesting, draw out highs and lows, draw out OBs, draw out whatever you see, just for you to practice reading how price is interacting, right? You can see price reacted off this PY right here, reacted off this OB right here, OB PY, whatever you want to call it, doesn't matter to me. Just as long as you understand mechanically how to define it, that's good. And ultimately, you can see after the fake move, we took out all those traders, and I hit my TP of about 4.5 risk reward. So at this point in the day, I was up 4 risk reward. Now we had a huge move. Why? Because we're at all-time highs. So it makes sense. We got very close to 3,000 here, actually extremely close. But we failed, right? And we came back. And when we came back, this is a lesson right here. I took this OB entry model right here. Okay? I was marking this ahead of time as inducement, but what I was thinking here is that I'm able to trade this pullback here to mitigate this missing OB that never got mitigated here, to then go lower to the real POI. So now this is something a little bit more complex, requires a bit more skill to anticipate and trade. Most people would probably not trade this, but with enough experience, you're able to read certain things like this, that you can make certain discretion decisions. And also, in fact, we technically did take out this low right here, right? Which is inducement. So I call this an inducement play right here, since we did take out this low, and I was anticipating nonetheless for price to come back anyway. So this was a very small 2R-ish scalp just to make some more profits. I was very confident in this hitting based on everything aligned, right? We took out external liquidity, we took out this intermediate low. Well, basically we took out inducement here, we made a confirmation entry model, and we have this high here that I believe needs to be taken out before we go lower. And a lot of this, you could say, also comes from experience, but mechanically you guys can understand from a technical perspective what's going on here. Now, this is the main part of the video I want to discuss with you guys. On the left here, we have the 5-minute chart. On the 5-minute chart, what do you guys see here? We see this 5-minute OB, PY. That needs to be mitigated. So people that are trading the 5-minute for their entries, they're putting a limit order at the PY in OB and targeting this low here. Knowing that, I only want to really target this 5-minute right here. I don't want to be targeting this 1 minute up here. You can, certainly, for sure, but it's not guaranteed, right? It's not guaranteed for price to come all the way back up here to mitigate that 1 minute, especially since knowing it so far. but rather just mitigate the 5-minute. This is why, or this is going to be part of the main topic of today's video, is basically having multiple time frames up. And you don't need to have something crazy. You don't need to have 6, 7, 8, 9, or a ton of multiple time frames up. You just need to essentially have at least a 1 minute and 5 minute per se for our trading strategy that I'm teaching you guys. Intraday, 1 minute and 5 minute are the most important time frames to trade and have up for PYs and entries. So that's why I always have the 5 minute no matter what on the left side of my screen, and a 1 minute in the middle, and the right side does not matter as much for my time frames. So if someone did not have the 5 minute up, let's say you didn't have the 5 minute time frame up and you just saw this on the 1 minute, and you didn't have my indicator here, the ETU PY private indicator that marks out secondary time frames, right? So you wouldn't have seen that 5 minute labeled 5 minute. You wouldn't know where to target here. You would have no clue that there was a 5 minute PY waiting for price to mitigate there. You instead would have targeted this 1 minute OB, and look what happens. You would likely hit stop loss or most likely break even here, right? Instead of catching a 2 RR trade and a 4 RR trade. So instead of making 6 RR here, you would get a break even. And that's a very big difference, an extremely big difference. So that's why I highly suggest, if you don't have an indicator to mark out secondary time frames, please have at least your 5 minute up for intraday trading. This way you're able to see certain things like this ahead of time and not have crazy targets, right? So this is my target here. I made 2 R there. And here, basically OB entry model right here, right? I got filled like about here, okay? But you can see on the chart, it also did mitigate the OB for the entry model here. You would have set a limit order here. Obviously, you guys know how to trade the OB entry model. And you would have caught 5 risk reward here. I wrote 4 risk reward, but basically you could have caught basically 5 risk reward here. If you target the low, it would have been 4 risk reward. If you target the origin, it would have been 5. For me personally, I just like to round down just for drilling purposes. And also, don't forget, there's also spreading commissions that do cut into your trades. But I just like to personally be humble and round down my numbers that I put on my chart sometimes if it's very close, right? If it's like 5, I'm going to round down to 4. But again, this does not really matter much to your trading, right? This is just a personal thing that I like to do. That's it. So anyway, we'll keep at 4 reward today. And I target the origin here, right? Right down here. We have the origin right here. And you can see there's even times where the 1 minute will show very specific details of PYs that are unmitigated, while the 5 minute does not show any unmitigated PY here. That's why, again, like I mentioned, you must have this duo of the 1 minute and 5 minute together when you're intraday trading. And eventually you can see we didn't have much drawdown here, really, if not any. And we immediately hit TP at the origin by a tick. You see how accurate the market is? The market is extremely accurate. Hit it by a tick, and at this point in the day, I was up 442. So I was already up 10 risk reward, which is what some people make in a month or 2 weeks. So you could imagine how good of a trading system that I'm teaching you guys. I made someone's monthly return in 4 hours. That's the power of understanding mitigation and expansion cycles in these phases, as well as understanding the 1 minute and 5 minute in the fractal nature of the market, and having something mechanical enough like my strategy I'm going to teach you guys here to execute. Next up, we have the inverse fair value gap here. I marked this ahead of time, okay? And see what happens here. We inversed it, and I took my entry with the market order right there. For, remember you guys, for OB entry models, I use limit orders. For things like inverse fair value gap entry models, I use a market order. And if you're trading impulse model, you trade with a stop order. But again, I rarely trade impulse model nowadays unless it's a really impulsive delivery. Something like this. Unless it's an impulsive delivery that makes sense with a small range. Otherwise, I don't trade the impulse model. Right? Something like this. This is a very good time when you should be trading an impulse model because it's all imbalances that need to be immediately filled. So this would have been a perfect impulse model where you put your stop order right here. So you get immediately executed as soon as that low breaks, and you get the best fill. But again, mostly I stick to OB and inverse fair value gap models nowadays for my entries. So now basically enter this, and this was about a 3 risk reward. You could have, remember, The most conservative stop loss is down here for 2 risk reward. But me personally, I don't mind taking a higher risk to make 1 more risk reward. So this is something that will be more subjective to each person, but just make sure your stop loss is at least somewhat reasonable, right? My stop loss is reasonable because I'm covering this 5-minute POI basically. And again, you won't see this 5-minute POI unless you have the 5-minute chart up or an indicator that shows there's a 5-minute POI, right? Like my indicator right here. That's why I use the indicator so much. I love this indicator. It took a lot to code, a lot of time to code and write. It's like 500 lines of code, but it works very well. And I use it every day. And it automates everything for me, marks out POIs, things like that. So you can see that's where I decided to just risk my stop loss. Just make sure your stop loss is, at least if you're going to go aggressive like me sometimes, make it reasonable, right? Don't have your stop loss randomly in the middle of here and try to think you catch a 1 to 9. That's rarely ever going to happen like this, okay? So I was targeting obviously the week high here because we tapped into the origin. And of course, this is a external continuation model. You guys know this, right? It's a continuation model. So of course we're going to target the week high. And if honestly, sometimes if you're really scared that we might have a mitigation phase, which we mitigate here, come back down here, and then we go higher, which could hit your break even. If the origin is very close to the week high, you could theoretically just target the origin here if you're scared, right? Because 2.79 versus 3.21, it's not a huge profit difference. I will say over the long run, having a 0.5 R profit difference between all your winning trades will make a huge difference. But if you're scared and you think psychology cannot handle this, target something more reasonable. Target something more conservative. So here we have the previous day high because this was the next session, right? And here we have the 5-minute POI right here. And you guys know what I say for 5-minute, I usually like to mark, if I can, the buy to sell or sell to buy, which is what I did here for my 5-minute POI. Typically, I only do this if it's a big 5-minute POI or 5-minute OB, right? This is a big 5-minute POI here. If I was going to mark the actual POI, it would be this big. This is massive. So I marked the buy to sell, sell to buy. The point is, it doesn't really matter that much as long as you're understanding essentially price action in terms of confirmations, right? So in this trade here, let's see what I entered off of. For this trade here, I entered off of here. Okay, should have marked this earlier. This is a POC here. It's a miniature POC. You can use these also, like I said, to enter. In this case, price did indeed hit the OB right here as the OB entry model, which is perfect. We got a really nice risk reward, right? But I entered off the POC here because sometimes price doesn't fully mitigate that and mitigates the POC. I entered on the POC and you can see price immediately shot up. And in this case, I just had a conservative target here and hit 6 risk reward, right? For me, sometimes if the risk reward is already extremely high, anything over, I'd say anything 6 risk reward or higher is considered high risk reward for me. I don't mind having a conservative TP because that's already a lot of money. That's already a lot of money. You don't need to be greedy. Even though if price does go 12 risk reward, you don't need to be that greedy. 6 risk reward is already a lot. And if you're in drawdown, let's say you're in drawdown, this will be a very good way to crawl out of drawdown. 6 risk reward is a lot. That covers 6 losses, guys. And like I said, 5-minute again, very important, right? Have the 5-minute marked up here, right? 5-minute chart, 5-minute POI. And in this case, you can see price actually did indeed fully go to the 1-minute POI origin. But like I mentioned, and you guys saw earlier, it doesn't always do that. Probabilities. And let's see what happens here if I remember clearly. This was an OB entry model here that I decided to take a risky entry on. And this line here is actually what I sent to the Discord. And I showed you guys how I was anticipating basically this market structure to occur to take out the week high again. I was anticipating a mitigation phase here, which did occur, right? It was a mitigation phase. It just took a much longer, right? We came all the way back here to the mitigation to continue higher. I'm going to delete this so it doesn't clutter the chart here. So hopefully also my webcam doesn't block too much of the screen. That's why I've been trying to avoid having my webcam on the course videos, because I don't want it to block too much. But I try to make it as small as I can where it's still interactive enough that you guys think will be beneficial to your attention spans. Had an OB entry model here, right? Here's a sell to, or bought a sell here. Here's an OB entry model. There's another OB above, so that's something you need to be very aware of. Again, I'm not taking this trade here. I'm not going to take a one-to-one risk-reward trade. You guys know that. And also, for me, when I see something like this, even then, this is not a good risk-reward for me personally to take the upper OB. So I just took a very risky trade here. This is a very risky trade, okay? So you want to, if you're going to break even, have something more aggressive. This is when you use a more aggressive break-even approach, either when price does the 1RR mitigation where it reaches one-to-one risk reward, or when a price reaches like a low like this, internal break structure, that's when you try to go break even with an aggressive approach. In this case, I took the aggressive approach of managing my trade, and as soon as we basically got down here, I don't know exactly if it made equal highs or took out this low here, but point is we got basically to the low, and obviously price should not be coming back in my opinion. If it does come back, I was anticipating price to come back to mitigate the higher OB. So remember, you always need to have actual steps. If something happens, you must understand what you should do next. This is all stuff you learn from experience, which, because this occurs like essentially live, right? This stuff occurs live. So let's see what happens here. We eventually go back up, hit break even, and we mitigate the 1 minute OB here. Now when we mitigate the 1 minute OB, I'm gonna get rid of that because it's blocking the screen. Let's see with the 5 minute. 5 minute here, you can see, like I mentioned, 5 minute you don't see anything unmitigated. 1 minute you do see it. We had an OB entry model here. You guys could see right there, mitigated the OB entry model, and we eventually just dumped. And my target here was the POC here. So do you guys see that? Let's go back. Let's go back. Another key moment where the 5 minute comes into play. Do you guys see how this POC here perfectly aligns with the 5 minute OB or POI? Look at this. My indicator is highlighting the 5 minute POI right there. You see it. This right here, 5 minute POI. Right here with this candle. You see the blue? That's where it is highlighting. My indicator is highlighting that. That's the 5 minute POI. And then look at the 1 minute. You see exactly on the 1 minute, that's exactly aligned with the POC. And that's the purpose of POCs. POCs will show you guys sometimes where there's another time frame where there's an OB actually made. Sometimes it's a 2 minute time frame. Sometimes it's a 3 minute time frame where there's an OB as a POC. They all align. Sometimes it's a 4 minute time frame. But for me, I don't like having all these time frames. I don't have 2, 3, 4. I don't check these time frames majority of times, right? I try to keep it as simple as possible, though this may seem complex to you guys at first, but with screen time and experience, especially journaling, journal all your trades, take screenshots, do all of that, and you'll later understand true price action. And that's also the point of, mentorship, things like that, right? Teach you guys reading price action like this. So you can see we eventually did indeed mitigate the POC. If I did not mark out this POC, or if see the 5 minute time frame, right? If you didn't know what a POC is, you still would have saw an OB on the 5 minute to be careful of the TP. You would have taken a break even on this short. Why? Well, because all you would have thought of was this 1 minute origin down here, and it never hit, right? Price does not always, like I mentioned, go to the origin or the 1 minute. Sometimes it'll go to the 5 minute. So here was a great trade here, 2 risk reward, 2.64. Like I mentioned, I round down when I journal, but on my P&L it's probably like 2.3-ish after commissions. And here is the next trade. I believe this was the IFVG entry model. That's what it looks like at least. Okay. And basically took a break even, right? Internal break structure, took a break even there. And I don't remember if this did go or not. This did not go. Okay, we took out this low again. Now, when we're within a PY that's valid, remember, taking out lows or highs, internal lows or highs, majority times, or not majority times, sometimes it could be an internal liquidity sweep to stop out all the traders going long originally to go long now. So that's something you want to keep in mind. It's not always going to be a continuation to now go to this 1 minute or go to this low. It could be an internal liquidity sweep, which again, I have videos and numerous videos on within the course. Here, I was too blindsided again with my bias of really wanting that 1 minute mitigation here. So I took essentially a OB entry model here. I don't teach you guys to trade this, so just ignore this trade. Honestly, this is not a good trade to take majority of times, but I did take it because I was thinking this high is way too high, far apart, just too much displacement for price to really go up here to then go lower. It will just mitigate this and hold this. So anyway, disregard this trade here. It's not a good example. Bad trade. And you can see it hit my stop loss. I moved my stop loss here because I knew I messed up after I saw price really hold this OB here. So that's when I realized this likely was an internal liquidity sweep. And what I do, change my bias. Now I have videos where I say don't change your bias, right? But the thing is, the reason why I say that to most traders is because they're beginners or intermediate traders that don't have enough screen time to understand when to flip their bias and when exactly they should actually change their bias. And I'm not changing my bias every second, right? I'm not here changing my bias after every single trade I'm taking, right? My major bias is still upside to this week high. We're at all-time highs. Of course, we're going to keep going higher. We're bullish. We're extremely bullish. Not even like consolidation. We're high time frame bullish. So you can see I took a stop loss here. Basically, I just wrote -1 restored for journaling purposes. This would have been -0.5, but we'll keep it at -1. Here, essentially, after this wick stopped me out right there, I essentially basically took and waited for a entry, which I got very, very quickly, right? You can see right here, I got an inverse fair value gap model entry immediately. This bullish candle, I entered here immediately, stop at the low, most conservative stop loss, the proper stop loss for most trades, right? And you can see we did not hit TP. Let's see. Did I mark this? Was I marking this? This is the opening price for my indicator. Sorry. Ignore that line right there. That's my indicator opening price. You can see essentially what I do sometimes is practice marking out my charts, reading price action, right? I marked out this low here. This low here looks like internal liquidity. That's supposed to be swept. If we want to go higher, this is right here, I recognize is a fake OB entry model to go lower. Now a lot of people again ask, how do you know this is likely a fake OB entry model? Why? Build context. We have trendline liquidity up here. Okay, that's all mitigated. There's nothing unmitigated here. Mitigated, and this just got mitigated. There's nothing else unmitigated above. We're likely to take out that weak high also. So I know this is a fake move to go to the downside. And eventually you can see we took out those sellers that sold early and we hit TP here. Now yes, this could sometimes, like I mentioned, this could be just a mitigation phase to come back down here to go higher again. But remember the probabilities of that, it's much lower probability than price going for that weak high, because price likes to generate liquidity and trap people that are thinking of shorting. So again, took out that weak high, 3 sword right there. I know this is probably going to be a super long video. It's already 30 minutes. I don't expect this trade recap to be this long, but I do believe I bring up a lot of important things that a lot of people that are lazy will not watch these trade recaps, right? Some of your course members or just viewers, some of you guys will just not, subscribers, you guys will not watch all these trade recaps or even watch any of the trade recaps, and it is what it is. The reason why I make these trade recaps is I try to teach something not necessarily new, but interesting knowledge that I think is important to you guys in the trade recaps, because there's no point in making a separate video for them, because the video will be like 1 minute long, and I'd rather incorporate all the price and show you guys on the chart than that. So here's an inverse for value gap model here. I entered on this candle here. You could have entered a little bit earlier off that candle because it had a closure, but entered here again just because when the candle closed here, there was no OB entry model made anywhere here, which makes it a little bit low probability. So I waited a little bit more. I saw we had a nice closure and I just took it, honestly. And What made me also very likely take this? Well, first off, we took out the external liquidity already, right? And you guys know when we take out external liquidity, we will have some sort of pullback at some point. It's not always, right? Price will sometimes do fake outs and then go lower, but not always. And that's why we wait for entry model confirmations like inverse value gaps, OB entry models. And another thing of context is I saw everything's already made on left. So when you're trading, sometimes what I like to do is I like to write notes on my chart when I'm trading, when price is actively moving. Everything's already mitigated on the left. Look on the left here. Everything's already mitigated on the 5-minute even. There's nothing that's unmitigated left. Everything's already mitigated. 1 minute, everything's already mitigated. Actually, in fact, I think this didn't get mitigated. That's really hard to tell here because there's some differences between micro and minis at times. This might have not been mitigated. On this chart, at least it technically was not. But seeing this anyway, regardless, you would have at least targeted here or the low. For me, I was targeting a low here. So let's see what happens. Eventually, we hit the TP, and that was easy through your sword. Not my favorite stop loss. It's very big. Preferably to have it there at that intermediate high, but still risky, like I said, right? I would have had my stop loss again at this intermediate high if it was a bad risk reward, right? If this was like a 1 or 2 risk reward trade, I likely would have had my stop loss honestly at this intermediate high and taken that risk. But because it's 3 risk reward, I was like, it's also a lower probability, because we're counter trending technically. So I was like, you know what? I'd rather have a safer stop loss. So there's a lot of things that go into your brain when you're live trading. There's certain decisions like where to place a stop loss, things like this, where you have to basically make these decisions on the spot almost when you're live trading, right? It's not like backtesting where you get time to think. You have to practice from backtesting, build that muscle memory, build that experience and screen time to be able to make these decisions quick, right? There's so many different types of decisions you make. And if you want to really simplify your trading, just have your stop loss at the high or low, right? Don't try to do intermediate highs or lows that could get swept and go like this, like me. Just have it at high or low, honestly. That will simplify everything for you so you won't get confused. This trade here, we had an inverse fair value gap right here that we inversed, body closure above, and we TP'd. I made a mistake on this trade here. I'm going to explain real quick. Let me get rid of this fib tool. This trade, I was trying to so basically I entered, right, and I didn't see this earlier, but I should have had my TP here because I knew this was inducement here. This is very likely inducement. We had a small pullback that didn't mitigate anything and made an internal break structure, and these small pullbacks that you consider inducement, sometimes it's a little bit discretionary just because it's not that easy to mechanically define inducement. All I can say is it is small pullbacks that don't mitigate really anything and continue lower, right? If this mitigated up here and then went down and has a new OB, then that's a completely different story. But this clearly looked like inducement to me, and we're bullish, so keep that in mind. I basically went and target. I just have my TP set here real quick because I entered, and you see within a few minutes, price was already shooting up extremely fast, and it just TP'd, right? I just had a conservative TP set just because I didn't see this, like I didn't have really much time to analyze this price delivery like here to know that this was inducement. So I later realized that, and guess what happened? I waited for my stop hunter strategy. Patience is key in trading. So I waited for stop hunter. We swept this low here that a lot of people would call, a lot of ICT or whatever traders would call this a 2022 model, whatever it is called, and try to short here to go lower off that fair value gap or OB. And we are running their liquidity. Their liquidity for us because we know the stop hunter strategy where we have the right draw on liquidity. Draw on liquidity is extremely important. Draw on liquidity literally is more important than your entry models because entry models can be fake reactions like I mentioned in the market. So here, stop hunter, I entered market order as soon as we swept that low. I have my stop loss basically prior to the mitigation of this PY or OB because I did not want this big stop loss. First of all, this is an awful stop loss. Second of all, I done optimization knowing that tighter stop losses are better for a stop hunter in the long run because of the high risk reward. And also, this is one of the stop losses I teach you guys, right? Having a stop loss You can either cover the OB, cover structure, cover the buy, sell, buy, or cover prior to mitigation, which is what I did. I'm anticipating price to not mitigate here at all. And whatever happens between this mitigation here and this low here, so this fair value gap here, anything could happen. There could be different types of structure going on here. That's why you don't want to have your stop loss really in the middle of this fair value gap. You want to have it at the right below, right there. So another gem right there that I did not talk about, I believe. That is the 3 risk reward trade here. So we did 3 risk reward here, and we did 1 risk reward here. I don't think I marked. I don't think I journaled this 1 risk reward trade, just because it's kind of like a, like it's a 1 risk reward trade. It's not gonna make a difference. So I journaled the 3 risk reward trade, TP'd at the origin here. Again, at this point, you don't need to be extremely greedy, especially knowing we already made 2 breaks of structures to the upside externally. 1, 2. Or even 3 actually here, which is a lot. And what I teach you guys in the course, like I mentioned, is after 2 to 3 external break structures for continuation models, be careful, because at some point price will reach some sort of high timer PY on the left and switch directions from bearish to bullish or bullish to bearish. However, gold is at all-time highs, so there's nothing on the left here. It's a blank space. But anyway, nonetheless here, this was the last trade I believe I took. Let me play this all out. I believe this is the last trade I took here. Yeah, this is the last trade I took, I believe. This was the OB entry model right here. Like I mentioned, this one actually hit the extreme here, but not always. So that's up to your trading plan and system. Whatever you're comfortable with. I drew equal highs here. I don't use them really often, equal highs or lows, like I tell you guys within the course. But I've been just digging a little deeper into them, seeing if they matter much, and they really don't. Like, price never took out those equal highs anyway. So 3 risk reward here, and basically TP'd at right here. Where was this? I think this was the, yeah, here you go. Here's 5 minute. I TP'd at the 5 minute PY. So again, another time where the 5 minute comes in clutch, right? A lot of people, if you don't have the 5 minute up, you would target this 1 minute OB right here, down below, this 1 minute origin. And let's see if price actually even hit the 1 minute origin. I don't remember. It never did. And you would have got a stop loss hit, right? So, man, always have your 5 minute chart up. It's very important, especially when price is trending heavily in pro trend in one direction. You definitely need to have it up, because price is not like very, very deep mitigations when it's trending heavily, right? It would like to preferably reach something a bit sooner, in this case, which was the 5 minute, and go higher. So, yeah, you also don't want to throw away a 3 risk reward of profit, or even go negative if you don't go break even, right? Now, here is when I stopped trading. This was basically all the trades of this day I took. I'm not going to go over. You can obviously find your own way of understanding how you could enter this trade. There's inverse fair value model here. There's the OB entry model here. There's also OB entry model down here. If you took the higher OB entry model, your stop loss is massive and it's really not preferred. But luckily, your TP is far. Your drawn liquidity is far at the week high. So it's theoretically you could do that. Another way is you could have OB entry model here. And the thing is, this is hard. See, this gets very close to your stop loss, and this is a very risky trade like that. So you probably would have had to find some way to enter here, but I did not enter that trade. I was done by 11 p.m. So let's go over real quick the math in today's video. So -1 +1, 4, 4, 2. So that's 10 risk reward plus 3, 13, 19, break even, 21, -1, 20, 23, 26. We're not going to count that 1R. 29 plus 3. Plus 32 net risk reward in just, let's see, how long did we trade? How long did I trade here today on March 13th? About 10 hours of trading. Okay, 10 hours of trading. Now, of course, there's a break, right? Because of the time. Spread hours from 5 to 6 p.m. EST. There's spread hours. So obviously, I took a break. I was not trading 10 hours straight on my computer. Do not trade 10 hours straight. That's never a good idea, personally. unless you can handle it, or unless you have a lot of free time, which I doubt a lot of people do, unless you're training full time already. But by then, if you're training full time, you should be already consistently profitable. Okay, I'm able to trade a long time for each session and hop in whatever just because of my schedule. I don't have any obligations really, right? Again, like I said, I trade full time for my income, so for me, it's completely up to me whenever I want to trade. But for people that work schedules, that work part time, whatever, try to pay some bills at least while funding their trading account, I completely respect it. Do what you gotta do, right? And yeah, that's basically it for today's video. Going over the importance of basically having the 5-minute chart up. You guys now understand how important having a 1 minute, 5-minute combination is. Otherwise, if you're someone that's like just on the 1 minute, okay, so what I used to do is I would have one chart up, right? And just switch between 1 minute and 5 minute. I'm not gonna do that because it's gonna mess up the chart right now, but I'll just type in the numbers. You guys know how TradingView works and switch around. The only problem with that is it gets annoying to a point where you have to switch around all the time. And I'd rather just be able to see the 5 minute just by looking to my left. So that's why I adopted this new system. And it's nice because instead of having a line in the middle where I have 5 minute on the left, 1 minute on the right, I have the 1 minute in the middle because, like I mentioned, the 1 minute is the most important time frame to me or to us intraday traders. So this is in just 10 hours. In just 10 hours, we made 32 risk reward. Guys, training my system, I'm teaching you guys right here. 32 net risk reward in just 10 hours. I don't know if you can name anyone else that's doing this. I'm gonna be honest. If you can, let me know, and we could even have a trading competition or whatever. I'm just joking, but seriously, 32 risk reward in 10 hours. If you're trading a funded account, let's say you're risking 1K per trade, that's 32,000 literally in 10 hours. There's no other strategy that I've seen in the world so far. After all the courses I bought my first year trading and everything, someone can make 32 net risk reward in 10 hours. Most people make 32. If you're a very good trader, you make 32 risk reward in a month or 2 weeks, right? So that's it for me for this video. If you guys did enjoy, again, do some back testing on your own. Check out the 5 minute and see how much it really helps and changes your TPs, because some people will get annoyed when their 1 minute POIs miss for their TPs when they realize there's something on the 5 minute, and that's why price reversed. And they missed both moves, basically getting a break even on the first move because they didn't TP properly, and then missing the second move to the upside or downside because they were waiting for a PY that was already hit based on the 5 minutes. So again, thanks so much for you guys for watching. Let me know what you guys think, and I'll see y'all in the next one.